Hi, and welcome to Options and Provisions. I'm your friend, Frankie Guzman from Valley Village, California. By the time we get through this section, you're going to understand what are options, what are riders, and what are provisions. Okay? The first thing I want to do for you, however, is define these terms for you. Okay? We'll start with provisions. Provisions is everything you can find, or are everything you can find inside your policy. You know that -4 font information in there, right? All that legal mumbo jumbo? That's provision. But more specifically, it is your rights and characteristics of the policy to help protect you, the consumer, or the policy owner. Riders. Think of riders as an extra bell and whistle that you can add to your policy to help customize it, to help modify it, to meet your specific needs. Now, these riders are going to cost you a little extra money, but the good news is that they're very economical. But the more riders you start adding, the more costly your policy gets. Now, I'm going to give you an example of a rider you might be able to relate to if you're married. Now, I know just like me, we love our spouses. But now, when we add the spouse to our policy, they become a rider. Why? Because our spouse does not have to be part of our policy. They can actually get their own policy. But again, what are we trying to do? Customize it, modify it to meet our needs. So once we add the spouse, there you go, bell and whistle, a rider. Options. Options are the choices you have, or even a beneficiary upon your death, to help distribute sums of money to the family. Okay, great. Now let's take a look and focus on non-forfeiture options. Those are one of your options that you have. Non-forfeiture options is the opportunity to get the value of your cash value in the event that you don't pay the premiums. You actually have 3 different non-forfeiture provisions. One is in the form of cash, while the other 2 are in the form of insurance. Okay? The one that's in form of cash is called cash surrender, while the other 2 that are in the form of insurance, one is called reduced paid up insurance, while the other one is called the extended term insurance. Now let's go ahead and take a look at each one of them individually. We'll start with cash surrender. Cash surrender is what I like to call the take the money and run option, right? It's when you get the money and the cash value paid to you in a lump sum. Now that sounds exciting, right? But let me tell you what happens. A couple of things happens when you choose this option. One, you're out the insurance. Now, I'm sure you'll agree with me that that probably wasn't your intentions to get rid of the insurance. Your intentions were probably to tap into the money in the cash value, am I right? So if you wanted to continue coverage, what you're going to have to do at this point, you're going to buy a new policy. Now, remember, you're older, so the premiums of this new policy are going to be more expensive. Secondly, you're hit with excessive fees and penalties that you'll see a portion of the cash value, not all of it, okay? So those 2 things that you experience with this option. Now let's go ahead and take a look at the other 2 that are a form of insurance, because as I said, this one was the form of cash. The first option you have is called reduced paid up insurance, and what we're going to do is we're going to take a look at how much was accumulated in cash value and calculate how much coverage you can purchase in a permanent product, and you're going to notice that the actual coverage is drastically reduced from the original amount. The second option you have is extended term insurance, and what the cash value is going to buy you in this option is time, because we actually know how much coverage we have. The coverage in extended term, it's a term policy, it's the same coverage as the original amount. So what's determined at the term of the policy is how much cash value is built up in there. Now, these are the 3 options. Again, you have cash surrender, you have reduced paid up insurance, and extended term insurance. But now that you understand those 3 options that you have, let's take a look at the example on your screen. You have a $50,000 whole life policy. You've had this policy for about 15 years. Now, after 15 years, if you choose the option with cash, what's going to happen after all fees and penalties? This policy accumulated $8,100. So if you chose the option of cash, this is what you'll receive, $8,100. If you chose the ones in the reduced paid up insurance, notice that you'll get a drastically reduced permanent product from $50,000 to $21,750. Notice again the drastically reduced coverage amount. The third option, extended term insurance, you know how much coverage you have. It's $50,000 coverage. Why? Because it's the same as the original policy. But what we don't know is the time, and in this example, you'll have it for 18 years and 60 days. So as a review, If you have a permanent product, and in the event that you don't pay your premium payments, you'll have 3 opportunities to get the value of the cash value accumulated in the policy. You have cash surrender, you have reduced paid up insurance, and extended term insurance. I appreciate your time. I hope this information helped you understand non-forfeiture provisions. Thank you for clicking. Thank you for your time.